Hi, everyone. Good afternoon. Thank you all for joining us, and especially to Jean-François, who had an incident on the way, but still made it within our time frame. So thank you for going the extra mile, extra few miles to get here. I just want to give a quick welcome to all of you before I pass it on to our panelists and our moderator. I also want to give a very quick welcome to our new colleague, Robert Mogielnicki, who just joined us exactly a month ago as our new resident scholar here, focusing on political economy of the Gulf. He has a few interesting projects in mind for the year, so we're very excited to have you with us and excited to work with you. So please, everyone, welcome Robert to our institute. And we have a wonderful panel with us this afternoon, discussing a book by Jean-François Seznec and Summer Mosis. And we're happy to be joined by Rachel Ziemba to act as a discussant and give some feedback on some of their major points. So without further ado, Robert, please.
All right. Great. Thank you very much, Raymond. I hope everyone can hear me. It's a pleasure to welcome everyone here today, everyone that's here with us, and also those that are watching remotely. I personally was very excited when I was looking forward to this event, mainly because we not only have an excellent selection of speakers here, whom I will introduce in a moment, but also because it gave me an opportunity to look at this topic in more depth. As Jean-François, Seznec, and Summer Mosis discuss in detail in this book here, The Financial Markets of the Arab Gulf, we know that financial markets are intimately connected to both the economic and the political dynamics of Arab states, but also they serve as a backdrop for some of the high-profile and very ambitious initiatives that are going on in the region. So whether we're talking about IPOs, privatization efforts, or bank mergers, and even the performance of local stock markets. So I'm going to get right into it here, and to give us a better idea about some of these dynamics, I'll just very briefly go over the backgrounds of our speakers here. To my right, Jean-François Seznec is a senior fellow of the Center for Global Energy at the Atlantic Council. He's an adjunct professor at Johns Hopkins School of Advanced International Studies and a managing director at the Lafayette Group. To my left, we have Rachel Ziemba. She serves as an adjunct senior fellow at the Center for New American Security. She also serves as a strategic advisor at Alpha Z Advisors, which is an equity futures fund, and she's the founder of Ziemba Insights. And last but not least, we have Summer Mosis. He's a senior analyst at S&P Global Platts Analytics, where he's leading the company's analysis on European, Middle Eastern, and African LNG markets. He's also served as a consultant at the Lafayette Group and worked with the U.S. Department of the Treasury and holds a master's degree from the School of Advanced International Studies of Johns Hopkins SAIS. So the structure of this event, I'm going to put forth a couple of broad questions just to set the context for financial markets in the Gulf. And then I'm going to put forth a more specific question that I hope the panelists will be able to engage in an insightful debate about. And then I'll turn it over to the audience. So I think without further ado, we'll get right into it. And my first question is for Jean-François Seznec. I was wondering if you could give us an idea about how the Gulf's financial markets have evolved over the last 50 years, and specifically, what have been the key changes that help us understand this evolution?
Okay. Of course, it's a very long question. It will take maybe 10 hours to answer that, but about 5 minutes we'll probably do as well. But I think I've been looking at these markets and at the Gulf since 1974, when I first lived in Saudi Arabia and helped start the Development Bank of Saudi Arabia. So I have more knowledge on the Saudi markets than on the other parts of the Gulf. But let me say that the evolution of the markets have been really quite interesting, because in 1974, when I first arrived there really was nothing. It was very much the Middle Ages, really, in many ways. But looking at the markets today, I would say we have to keep in mind 5 factors here. One is there are no foreign exchange controls in the Gulf. Anybody can bring any amount of money at any time in any currency. There are no controls on the movement of funds. People can bring money in and out of their accounts to the rest of the world. There are also, at the same time, which is sometimes in opposition to those 2 points, there's a very strong desire by the authorities, especially the technocrats, to avoid speculation in the markets. So the regulations are very tight to stop those regulations, and that slowed down the stock market for a long time, maybe not anymore. There's also, there's been since 1975 actually, in Saudi Arabia in particular, very strong desire to move away from being just an oil economy. And that is, we always think nowadays that this started with Vision 2030. That's not quite the case. In 1975, we were told at the Development Bank of Saudi Arabia to lend money to people so they would not be dependent on oil in the long term. The problem they had with that is that the price of oil went through the roof and it became too tempting to sell oil and really continue to do very heavy industrialization. Another point which we haven't mentioned enough, I think, in the markets in general, is that the technocratic structure in Saudi Arabia in particular is trying very hard to avoid foreign influence. They do not like to invite the IMF to help them with structuring their business. So given that, in 1975 and before that, of course, the markets were basically colonial markets. You had the big banks, British Bank of the Middle East, Banque de l'Indochine for France, Chase, and so on, had branches in Saudi Arabia. And they were totally, Chase did not have a branch, sorry, Citibank had a branch. And they were really basically working with the merchants who worked with these people. And in the case of ABN AMRO Bank, they were really working with the pilgrims that were coming through Jeddah to go to Mecca, et cetera, et cetera. So, but these people had a lot of cash on hand, and the brand new regulatory body, the SAMA, decided that they really need to control where the money goes, how it goes, and so on, and how perhaps they could use the funds to push the other agenda, which was to move away from oil. So they decided to Saudiize the bank to have more influence on them. So they told the foreign banks, and there were about 6 of them, I think, they told the foreign banks that they should become locally incorporated, sell shares to the public, and be 60% owned by the Saudis and 40% by the original foreign company like ABN AMRO, Banque de l'Indochine, Citibank, and so on. And that forced the banks to keep reserves at the monetary agency and whatnot. At the same time, some local banks were started. Basically the big financing area in the region then, or body, was the money changers. And people always went to the money changers in Jeddah. It's quite a sight to see, actually. And they got loans from the money changer. They gave money to the money changers on trust and so on. So the monetary agency tried to stop that because they could not control this whatsoever. So some of the banks, some of the money changers made themselves into banks and under the control of the Saudi Arabian monetary agency. And that was, in a way, good because some of these banks did rather interesting lending patterns and lost a lot of money. So basically the monetary agency decided to capitalize them. Now, as a twist today is they created a firm called the Public Investment Fund, and this Public Investment Fund used a lot of the money from the Ministry of Finance to fund the banks and to capitalize the banks. So that today in Saudi Arabia, the banks are basically controlled by the Public Investment Fund. That hasn't changed. So the largest bank, National Commercial Bank and so on, is majority owned by the Public Investment Fund. Now, the Public Investment Fund was totally the slave of the Ministry of Finance. But that has changed today because the Public Investment Fund was taken by Mohammed bin Salman and made into the sovereign wealth fund of the country. So today, the sovereign wealth fund of the country de facto controls the banks. And that's an interesting twist because I don't think they actually wanted that in the first place, but that's where we are today. The main item really that was of interest to me when looking at this was that the technocratic structure has been pushing the banks to not lend money over, even though they are very liquid, to not lend money overseas. And they really, most of the banks in the 80s, 90s, and so on were lending a lot of money through the euro-dollar market in London, but not the Saudi banks. The Sama told them not to do that. So they were left with a lot of cash on hand, and what could they do with that cash? And that cash, very simply, was invested in government bonds. It so happened that the Saudi government had deficits for 20 years running. And they needed to borrow money to cover the deficits, but they did not, they did not, how should I say, they did not borrow from overseas bank or from the IMF. They just bought, they could control their own money because it came from the banks, which they actually control. The other asset which the banks could put their money in was industrial development of very large firms. Most of these very large firms are state-owned, of course, but they lent a lot of money to Ma'aden, to some affiliates of Aramco, not to Aramco directly, and to SABIC, the big chemical company, etc. So they sort of pushed the development of industry in the kingdom in order to move away from oil in the long term. They haven't been terribly successful until now, but this is really where it started. So maybe I'll just leave it at that at this point because we can go on forever here.
Right, well, thank you very much. I know that was a tall order to tackle, and I think you did a really good job with the focus on Saudi Arabia. With that, I'd like to ask Samer if he could give us a sense of scale of the financial markets in the Gulf and the degree to which these financial markets are integrated across the region.
Yeah, absolutely. First off, thanks for everybody joining us, and thanks for having us today. It's a great opportunity to discuss some of these matters and to talk about the financial markets in what is an important region in many respects. To touch on the first question, I think it's smart that we break it down into different parts of the financial sector, so we can take a look at the capital markets and the banking sector. And just dovetailing with what the professor has been saying, Saudi Arabia is the largest economy in the Gulf, and in many respects, it tends to dominate both of these areas, right? The Tadawul is the main exchange in Saudi Arabia. This is the capital market. The capitalization is around $550 billion. That's about the size, slightly smaller than the Singapore exchange. It's not small potatoes. It's very large. But then when you start looking at some of the other countries, they are minuscule in comparison, and sometimes they're even competing with each other within the same countries, which is something that only further limits their ability to grow. But when you and throughout the capital markets, when you start looking at the effects or the desire to grow them, we start to realize that historically speaking, many of the things that kind of stimulated growth in the past are now hindering growth in some of these capital markets. I think one of the best examples of this is when we start looking at how moral hazard has become a primary factor in many of these capital markets. Kuwait's a good example. When we look at the Souk al-Maneh crisis a number of years ago, leading up to that, we saw that repeatedly there was government intervention at times of bearish market trading dynamics or the expectation for losses. And in that regard, there was the increasing perception by market participants that the government will save us, the government will step in, and that has hindered the ability or the sentiment moving forward that investors, from foreign investors, when you hear these governments now saying we're going to stop doing that. Well, when you stop doing that, what you are now looking in place of that is strong regulation. Regulation that will take the place of government intervention to ensure that there's recourse for foreign investors. And the problem is, while you have stopped doing one, you haven't stopped doing the other, or you haven't started doing the other. So as far as capital markets go, when we are starting to look at their size, in Saudi Arabia, it is a very large market, and its near-term listing in very large, important, emerging market indices is only going to continue to make that growth continue moving forward. But there are major obstacles in the future growth of these capital markets, especially when you think about how many of them there are in a very small region. Looking at the banking sector, historically, again, it has gone through a period of a number of phases. You've kind of swung from no regulation with a massive inflow of hydrocarbon-fueled capital, which led to a boom and bust very rapidly, and so you swung in the other direction, and you have hyper-regulation and even government intervention and government drive. And today we're in a position when you're starting to look at these banking sector markets and dynamics, the largest economies, again, the KSA and the UAE, are very saturated, and the banked population is very high. And you've started to see, because of this, there's a push into more and more of consumer finance. And even by the Islamic financial institutions, you see consumer finance. And we were just kind of talking about this yesterday around you can now get a Islamic financial compliant loan for your washing machine. I mean, they're getting money wherever they can, right? So it's a very saturated banking sector, and it's at a turning point, largely characterized by consolidation and mergers and acquisitions, and we've seen that in the UAE, and we've seen that in the KSA, and it's likely only a sign of what will continue to happen. The interesting point is that when you start looking at the smaller countries, it's the complete opposite. You've had almost a stagnation or an inability to grow. We look at Bahrain specifically. The banking sector in Bahrain, when you adjust for inflation, is smaller today than it was 20 years ago. Right? I mean, they are not seeing the growth. So one of the arguments that we try to get at in the text in the book is what could be if you start to see a consolidation cross-border, right? And you start to see a teamwork, and that really comes to your question about regional integration, or frankly the lack thereof. I think the professor wisely touched on a number of things that are consistent across these financial sectors. There's the free flow of capital. It's never been stopped. It's something that will characterize the region for a long time. There's little to no taxes in all of these economies, and effectively, if one of them tried to put on serious taxes, then companies would just tax shop, right? They would move to a different a different location for their business. So we don't expect to see serious corporate taxes in the near term. This moral hazard characterizes all of these economies in many ways, and the USD link, right? There is no single currency, there is no single central bank, but they're all linked to the USD. Kuwait's linked to a basket, but still, you start to see this kind of unity there. So as far as integration goes, that's the end of it. There is no more. The issue about the lack of integration and the real problem here, and that's the one that we try to really hone in on, is that the lack of integration in the regulatory sphere is what leads to some of the largest crises in the region. When you start looking at actions around regulatory arbitrage, things like the TIBC crisis, the BCCI crisis, the Abraj crisis, all of these are led by the lack of strict regulation in these markets and a lack of cooperation between countries in making sure that companies hold on to and act in accordance with the regulatory standards. For example, in the TIBC case, in the National Banking Corporation, when that went under, you actually saw disagreement between Bahrain and Saudi Arabia about who was responsible, and they did not cooperate to ensure that there was efficient bankruptcy proceedings. Instead, they each ring-fenced their own respective economies, right? So from an investor looking in outside, I say, well, hey, look, there's not going to be as much foreign government intervention to help me. They also don't have strong regulations to keep things in place. Where's my recourse? Where's my legal recourse? And that's a large hindrance to further investment in the region. And that's something that is within the power of these governments to work on. And that really kind of highlights what we feel is very important moving forward for these economies, right? Transparency around how companies should operate, unified regulatory standards around what is and is not acceptable, and without these kind of things, it's hard to envision how many of the reform goals will actually be realized, at least not within the time frame that they are put forth.
Thank you very much, Samer. I think that's a good point as a segue over to Rachel, who is really well positioned to talk on a broader level about how the Gulf's financial markets compare to those in other emerging and developed markets. So I'd like to ask you to speak on that a little bit.
Sure, happy to, and thanks for having me, and this is a great opportunity. One of the things that is, so I spend a lot of time work on the Gulf, but I also work on global emerging markets. And one of the things that's been a surprise to many, particularly dollar-focused investors in the bond markets, has been the role that the GCC, and to a greater extent also some other Middle Eastern issuance have played. Now this is partly a function that the GCC sovereigns and some quasi-sovereigns and corporates have been been come into the market in the last 3 years, 4 years sort of since. Part of that was a global oil price story and a shift in financing. Some of it was the fact that many other big, especially emerging markets, said, you know what, we don't want to issue in dollars. We want to issue in local currency because we don't want the currency risk. As Jean-François and Samer have both said, of course, the GCC has the dollar pegs, the dollar links, and so that's a different dynamic. But if we look at the 2 years ending in early 2018, the GCC sovereign and quasi-sovereign issuance was about $200 billion. Not all of that was U.S. dollar denominated. In last year, GCC sovereigns issued a little bit over $20 billion in dollar-denominated sovereign bonds. That compares to only about $100 billion globally in emerging and frontier markets. So this is a sea change versus if we went back to earlier this decade, there was almost no sovereign issuance. Bahrain had some issuance and the like. So there's been that shift, partly as other entities have vacated it. But it also means that investors have been increasing. Now, we've talked a lot, both here already, but about maybe the role of GCC equity and bond markets coming into global indices. It's happened first in the equity market, particularly with the UAE and Qatar coming into the MSCI emerging markets, Saudi Arabia coming in over the course of this year. Those are so far to date, these are pretty small shares. So there have been an increase in passive investment flows, but you're talking for Qatar and the UAE, this was like a 1% of the global equity indices. So not the same kind of game changer as increasing the share of Chinese equities or even Saudi Arabia. On the debt side, though, in this environment where on the issuance side, these are major players, some of the weights will be larger. Now, of course, other entities have outstanding stock, but this is an important game in town. Now, this leads me to some kind of concerns, and it leads me to describe a level of development, perhaps, in this dynamic. One has been that the shift away by many of the government entities away from, maybe I might call it altruistic sovereign bond issuance. By altruistic, I mean the goal of issuing sovereign bonds to set a yield curve for corporations and government-related entities, which was very much the driver of many local sovereigns if we look back only a few years ago. And it's still, I think, an important policy goal. And over the course of 2019, 2020, we will probably start to see a few more government-related and sort of quasi-sovereigns and even some big corporations issuing conventional bonds and sukuk. But this has been the story over the last 2 years where the sovereigns actually needed money. Now, in some cases, it was a choice. Borrow money today at what are low interest rates rather than draw down reserves, sell assets that might be illiquid. But still, nonetheless, we're in an environment where there are fiscal deficits. Maybe smaller this year than 2 years ago or 3 years ago, but still this is an environment, and it raises some concerns around crowding out. It also raises, I think, some concerns as the outstanding levels of debt become sizable. Now, you've noticed I've spoken for a number of minutes, and I've said debt many times, and I've said equity very little, which I think is an important reflection of where the flows have been. And it's striking to me that, well, there's been some increase in equity inflows across the region, and Saudi Arabia has probably been the most interesting case over the last several years, because looking back several years ago, it had a very vibrant and liquid local market. And there were a lot of boom and bust cycles that are talked about in the book, and Jean-François can probably talk about in much more detail than I. But this push to get foreign capital in. What I will note, though, is that we have not seen an awful lot of new issuance on the equity side. There have been some important issuance, a little bit here and there. I shouldn't call the ADNOC, sort of select IPO, nothing. That's important. There have been some others. But some of the issuance catalysts that people have been waiting for in the region and that we might come to later, particularly in Saudi Arabia, haven't happened. And while we can come back to this, I think the fact that there's not that sort of pathway to market, I think raises some concern. So major capital market dynamic, increasing global linkages, but very much a debt-led story, and a bit of a shift away from bank finance to debt finance, all of which I think raise some interesting distributional and other questions going forward. I'm going to stop there because I'm sure I took more than my 5 minutes.
It's fine. Thank you very much. I think one of the topics that all of the different discussions here touched on, and something that we hear quite a lot about, is competition between the different financial structures across the region and also within individual countries. In your book, the two authors here to my right, they argue that there's no room for a capital market platform in each of the GCC countries. And I guess my question would be, I'd like you to expound on that argument a little bit, and then also pose to Rachel if she feels the same way. If so, why? If not, I'd be very curious to hear your thoughts on that.
Would you like to take off?
Well, go ahead. I'll catch up.
Sure. I mean, I think one of the things that we, when you think about it, just take, for example, a retiree in the U.S., and they have their retirement capital, and they go, where am I going to put this retirement capital? Are they going to say, there's a really good emerging market down south, I'm going to go pop it in there? Or are they going to just put it in the S&P 500? Right? So when you take that idea and apply it to the Gulf, where you have a lot of families investing capital, an Omani retiree will invest it in the Omani capital market, and a Saudi retiree will invest it in a Saudi capital market. And in that regard, you start to see this divergence. You start to see this this inability for large capital flows to go to one location. And this has really hindered some of the smaller markets where we have not seen the growth despite a very, very concerted effort to modernize. I mean, the Omani and the Kuwaiti capital markets have put in so much work, not to mention the Dubai multiple capital markets, right? So there has been a strong effort on the behalf, but the capital just may not be there to support 6 exchanges, 7 if you count the commodity exchanges. And in that regard, I mean, I think it's hard to argue that there's a need for all of them. I mean, and I think we were joking about this yesterday, but when the U.S., many, many years ago, there were a multitude of exchanges. Today there's 2, and there's 1 for commodities. So I think that is the natural evolution, and that's the direction in which we would expect to see movement if you want to see real growth and liquidity.
Yeah, there's been a big effort in the region, especially in Bahrain and in Dubai, and now in Abu Dhabi as well, to create structures that would make it very attractive from capital from all over the world to come in. And Dubai started it really with the DIFC, which is really a marvelous place to visit. But they established an offshore market where they basically wanted to attract foreign money, mostly Saudi capital, and bring investors or industrialists from all over the place, Kazakhstan, Tanzania, and so on, to establish firms in Dubai who then would fund themselves on equity markets from Saudi Arabia, all that done at the DIFC. And basically, and they offered legal representation, legal advice, all under British law. And all the agreements were under British law. And that fundamentally has not worked out. There are only, a few, 15 or 16 companies traded in Dubai today. And that has not worked. And why? It's very hard to know why not exactly. But I believe it's because, first of all, the monetary agency of Saudi Arabia strongly discouraged, not legally, but strongly discouraged the big merchants to put their money in Dubai. They didn't really like that. They preferred the money to stay in Saudi Arabia to invest in Saudi Arabia's industrialization. But nobody has taken advantage of the DIFC's regulations and structures. Now, DIFC is a major success in real estate. It's a beautiful place. The buildings are fantastic. It's full. They make money like hell. But in terms of a financial market, it's just not there. And what's very interesting is that Abu Dhabi is now trying to basically copy Dubai. So are they going to copy the failure of the DIFC? I don't know, but it seems to me that's very much on the way. So the other market that could have succeeded was Bahrain. But Bahrain started in the 70s by establishing these offshore systems and so on to sort of provide to the market what the market could not offer. In the 70s, the banks in Saudi Arabia, as I said before, were in the Middle Ages and so on. So if you wanted letters of credits, deposits, and so on, you couldn't really do it easily in Saudi Arabia. So the Bahrainis established this offshore system. People would go and become suitcase bankers and go to Saudi Arabia, come back. It worked very well. But the Saudi banks very quickly realized that if they modernized themselves, they could take back that business, which they did. Then Bahrain scratched their heads and they wondered, what are we going to do next? And next, they did they went in very heavily into Islamic banking. So they established regulatory bodies that would provide good control on Islamic banking, and that worked quite well. And there are a number of Islamic banks in Bahrain, but again, the Saudis were really opposed to Islamic banking for years, for decades. Changed their mind and decided this is good business, and they decided to help the banks become Islamic as well in Saudi Arabia. So today, the market for Islamic banking is no longer based, no longer goes to Bahrain. It stays where it is, either UAE or in Kuwait or in Saudi Arabia. So the fact is now we get to what comes naturally is that people invest their money where they live.
Right.
So what it means is that Saudi Arabia, with 21 million people and 3 or 4 times the amount of the total GCC citizens put together, see their market very big. And I think that's where we're going on that. I think that's.
Yeah, those comments, too, about the DIFC are quite timely, given that today I think DIFC announced that their net profit for 2018 was 11% or something like that. So we have these figures coming out, but I think you give us some good context there of how to think about where those profits are actually being driven. Over to Rachel.
Yeah, if I can just pick up on an important point, I think both Samer and Jean-François highlighted the home bias and that it's very localized home bias. But I think it's kind of important to think that some local retirees or individuals or rich families, of course, invested locally. But of course, there's, this is still a region that has quite sizable foreign investments, both obviously at the sovereign level, at an institutional level, but also individuals. And so I think one of the dynamics that's telling and is talked about very much sort of in the book and more generally is this: as local markets developed greater depth, that money stayed at home, but there is still this broader issue around the foreign, sort of the foreign holdings and the like. And there was some logic of diversifying flows, not being solely tied to the local business cycle. But they're sort of different elements of home bias than we might see in other developing economies. Now, of course, and these are, economies that very quickly went to very rich per capita levels, by and large, unlike some others. So home bias looks differently. I would concur with, I think, a trend at the risk of, sort of agreeing too much on the panel. That's never the mark of a good event if we all agree on things. But I do think the competition issue is a problem, and there, and that's a known issue for quite some time, and it's hard to resolve it. And in some ways, I actually think it's probably getting a little bit worse in some ways. I will sort of, I think in a way, the UAE is a microcosm of that, as we've just talked about. But there's different levels of regulation on capital market dynamics, on data protection and governance, all these important initiatives. So that's where I think, and we might talk about this more later, that's where I think some of the consolidation trends that are going on now are interesting and worth watching. We've seen some more consolidation in the banking sector, some consolidation among the sovereign funds in the UAE, mostly Abu Dhabi, a bit of moves towards consolidation on dealing with what is a very large overhang of real estate coming. Other news today kind of from Dubai was a little less optimistic. Maybe one of the things that helped net profit in the DIFC is that generally rents commercially and otherwise have been going down. So I don't know whether their cost structure also went down. Sometimes that's flattering. Something I haven't dug into the details yet. So, but I do think that question mark of what can be done to coordinate, to avoid inflating costs. And in this context where we're looking at a global environment where liquidity is likely to be less extensive, where fees on risk assets, returns on risk assets are likely to be lower in the next 5 years than in the previous 5 years, some differentiation could be quite important. Joining global indices can be an important part of channeling the funds. The question mark is locally, at the government level, at the corporate level, what's the story they're telling to get in and maintain those funds?
Yeah, absolutely.
Please.
And I think you make a excellent point again. For hope we don't agree too much here, but with respect to the UAE, I mean specifically because Abu Dhabi and Dubai have developed in such different strains, right? The tones are different. And when you look at one, it's very externally focused, and then historically, Dubai has been a trade center, and this is nothing new, and they've built on that. And Abu Dhabi's kind of done the traditional industrialization, hydrocarbon kind of move. But what we've seen specifically in 2008 and since then is that despite their differences, they're very interdependent. I mean, when you look at the debt crisis in 2008, 2009, and the need for Abu Dhabi to step in, that wasn't just niceties, right? If one was to sovereign default, then that has a very poor reflection on the other. And it shows that not only are these markets now intrinsically linked to global fluctuation, but they're intrinsically linked to each other. And it creates a situation where the need for teamwork and the need for cooperation is just even higher, right? I mean, it has to be recognized. And there has been some vestiges of this, right? When you look at the changing of the oil price complex that Aramco has put forth and the use of the Oman contract, that's kind of a fig leaf, right, to that exchange, and that will increase liquidity potentially. So there is a lot in that market. So there is a lot of attempts, or there are spaces for cooperation. They need to be followed through.
Thank you. Another topic that each one of you discussed over the course of the last few statements really has been the role of local governments in these financial structures. And one of the points in the book that I found interesting, that hopefully will engender a bit more discussion and debate, was that the next 40 years, you believe, will see a receding of state control over markets in the Gulf. And I wanted to pose, why is this likely to be the case? And also, Rachel, do you believe this to be occurring?
I'm not sure. I mean, yes, the technocratic structure in Saudi Arabia, is such that it's very hard for them to give up. They do control, and they like the control, and they have their own vision of where they want to take the country. What's happening today, of course, is with the vision of 2030 coming from Mohammed bin Salman and his group. It's actually quite different than the vision which is carried by the Ministry of Energy and Khaled Al-Fari in particular. So I'm not sure. De facto, there are some efforts to free the capital markets, to make the share markets, Tadawul in particular, much more important, to get the private sector to use the Tadawul to float a lot of shares. This is beginning to happen a little bit. But at the same time, you have the technocrats who really want to make sure that there is transparency at the level of Saudi Aramco in particular, and SABIC and the other companies, while what the Public Investment Fund does is totally opaque. And I think there's very much a discrepancy here. So whether or not one could say, okay, if there is more transparency, there would be less regulatory impositions. But if PIF continues to stay as opaque as it is, then there will be more regulations and more control by the state, and we won't know what it is. And so I think it can go either way at this point. I'm not sure I agree with myself from what I said in the book here, but I don't know, Samuel. What do you think?
Well, I think it's a very important topic to touch on, because what you would expect to see if the reform process is followed through is this receding of government control. But you've started to see, and frankly, this has been, I mean, this changed as we were writing the book, and it's continued to change, where you start to see the sentiments around the PIF's breadth of responsibility and the degree to which there is intervention in the KSA really bring into question the commitment to the reforms, and that's not new. This is the Gulf, and this has been the tone for 3 decades, right? But at the same time, there had been an understanding or a momentum in one direction, which would point into this receding of the methodology that brought about economic growth over the 80s, 90s, and the early aughts, and that would be strong government hand in banking and capital markets and industrialization. That may no longer be the case. That may now start to recede. And in that case, we wouldn't see this receding of regulation. But you would hope, and we do hope, that what has begun, and while it may have slowed down, it continues in this change, and that you don't see the PIF take on too large of a role that becomes dangerous and stymies reform in other parts of the economy.
And to your point, Rachel, the enormous amounts of money that have been, or there are large amounts of money that have been borrowed by Saudi Arabia in the last 2 years is really, that's brand new. This is quite new. In the past, they never borrowed ever. It was like, you know, the holy script here. You never borrow from the foreign markets, because then the IMF will try to control you. And that's, you know, they prefer to control the IMF than the IMF controlling them. And this is brand new. And quite honestly, I really don't think that the technocratic structure in Saudi Arabia really wants to borrow overseas. This is coming from another center of power, and it is to show that we have an image in the world. We can borrow $10 billion just like that, which is not a small amount. And now we're talking about borrowing $70 billion to buy SABIC. I'm not sure they want to do that at the Ministry of Energy, but you know, they could issue shares, but PIF needs cash, so they want cash. So this is changing very rapidly, really.
Yeah, no, I would agree. So I guess the first thing I would say in the quote is 40 years is a long time. And I think that looking ahead, and I think this is something we all agree on, is that if there isn't this receding or shifting role of the state, then it will be a rather, there are a couple of different very distinct scenarios for the region. And so the government-led development, which can at least ostensibly move much faster than changing the rules of the game, you know, I think it's very difficult, and not just in the Gulf, but looking at other countries with a sizable government role in the economy, it is very difficult and somewhat disruptive when you take an economy that runs to some extent on pump priming, directly or indirectly, and sort of say, hey, it's open season. Now, I'm not saying that's what happened, that there was an attempt to do that, but I think there's a key question mark and tension between, is the goal achieving some of these objectives economically or financially, or is it how that has occurred? And so I, as an analyst, am watching very closely, you know, which of the pledges and dynamics are ultimately more important, what's the goal, you know, sort of what's some of the goal here. We can look at examples in the last few years, many more, I think, very palpable from Saudi Arabia, but also from other countries in the region, where things like government suddenly not paying contractors and workers then clamped, you know, led to a freeze up in the private sector, so that question mark of government, the need for government to keep things running. So I think predictability from where the government's going to be involved is important. And for foreign investors looking for the long term, they should be looking at what are the new rules of the game on things like payments, still question marks about counterparties. It's, I don't want to harken back too much to what occurred in the Ritz a little bit over a year ago, but there's some key questions which are don't necessarily need to be answered if you're just buying debt. But if you're investing in long-term projects or investing in equity, then thinking about what's your sort of common interest with your investment partner, those things are important. And some of that will be developed over time. So I guess the question mark is, in the short term, it seems to me the most likely scenario is it is still quite government-led dynamics. And there are those trade-offs between what's that money going to be used for. And that is something that may depend a lot on what's the oil price environment, what's the global environment, what do some of the partnerships with other emerging markets where governments have a strong role. We've seen a greater Saudi and UAE co-investment with Russia in the last few years. We've seen greater partnerships with China. For some of the conversation we've had here, as I've been listening to Jean-François, I've been thinking about examples in China, where, of course, its sovereign wealth fund ended up with some big stakes in the state banks as well. And there are dynamics of, we've seen China increase the role of the state in many elements of what had been sort of private sector. So I think there's a lot of scenarios going ahead, and maybe many of us will be here 20 or 30 years from now to sort of come back and see how our hedged predictions turn out.
I'm sure.
On that note, I think it's important. We said a lot of things here where there's like not trouble spots, but issues that need to be looked at. But one of the positive things I think that we should highlight, about the rules of the game is about this investment is bankruptcy. Yes. Bankruptcy laws have just are recently or just passed in KSA in the UAE, and these in many ways are a game changer. And now we're just looking to see if they will be applied in a manner that's up to international standard. But what I don't want to give off is that this is like a lost cause and there is no effort. There's a lot of effort and there's a lot of things that are positive, and it's much easier for us to highlight the things that are roadblocks than the opposite. But this bankruptcy law thing is something that's good. We'll see. And we mentioned TIBC and GoSebi and most importantly now Abraj. These are things that we need to see how they're dealt with, right? And DIFC so far has been great on the Abraj case.
Yeah, and I would just add that it's not clear to me that just because something's government-led, that's necessarily a bad thing.
Right.
It depends what the government does, how the incentives are aligned.
Great. Well, thank you very much. There's so much to talk about here, but I would like to turn it over to the audience at this point. Please keep your questions, keep them short. If they're not questions, I will jump in and ask you to make it a question. So, yes.
Thank you. Mimi Burke from Brownstein Hyatt. And Professor Seznec did touch on the Saudi Aramco IPO. And I'd like to get into it a little bit more and ask the panel if you have any information on where it is, why was it put on the back burner, and perhaps also what happened to the 5% offer from China?
We actually have a good bit of information in the book on the IPO. We spent a good bit of a chapter on that. And as far as we can tell, the IPO is still going on. It will happen, according to Khaled Al-Fali at the Atlantic Council conference in January, where he gave his speech there in Abu Dhabi. He said he will do it by 2020. They have done a lot of progress in the sense that they audited the reserves, the oil reserves of the kingdom, and increased them a little bit, the English company that was doing it. So they have done some financial audits. We don't have them, of course, but some of them were leaked at one point, so we, on purpose, of course, I suppose. So we have some information of where they're going. The problem is, a year and a half ago, Saudi Aramco changed itself to a corporation, which it wasn't before, and they issued shares. And of course, one of the biggest questions we had is who owned the shares? because when the whole privatization issue was started, the Crown Prince hinted at the fact that the shares would be owned by the Public Investment Fund, which would that make the Public Investment Fund a $2 trillion investment fund, which was a little bit big. And mostly it really totally upset the technocrats, because if PIF, which is somewhat independent and directly under the Crown Prince, is no longer controlled by the Ministry of Finance, how does the Ministry of Finance cover the expenses of the kingdom? And that just was not resolved. So eventually they made a deal, and in fact, in this room, I asked one of the Saudi representatives who has the shares, and he actually answered, to my great surprise, and he said it was the Ministry of Energy. So the shares now, Saudi Aramco is owned by the Ministry of Energy. Now, the idea would be that eventually 5% would be passed on by the Ministry of Energy to PIF, who then would sell the shares to the market and, God willing, receive $100 billion for those shares. And by the way, the valuation, we spent a fair amount of time in the book working on the valuation, and I agree with that valuation. Well, I agree because I wrote it, I guess. But so I think $100 billion is a fair price, and that would go as cash to PIF. But there's still a lot of disagreements within the government, I think, on how the shares are going to be managed, who will manage them, and so it's really slowing down the IPO, I think. I think what we are going to see, so the compromise, the immediate compromise, since PIF wants cash on hand today, they say, okay, we're going to sell our biggest asset to Saudi Aramco, which is SABIC. The chemical company. SABIC is the largest capitalized chemical company in the world, and it's the 5th in terms of sales. So it's a very important company and has a lot in common with Saudi Aramco, and there could be a lot of synergies between the two. But that is going to be a lot more difficult than it seems, because, as I said before, Saudi Aramco would have to borrow $70 billion. And even for Saudi Aramco, that's a large amount of money. If you take the leverage of the company, it's not that much. But for the market, $70 billion is a hell of a lot of money in one borrower. So I'm not sure that's going to happen. So to be quite honest, we don't really know where it's going today. Saudi Aramco just announced in January they were going to borrow $11.5 billion from the market. But they did not say it was for the purchase of SABIC. They need this because Saudi Aramco has a whole policy now of going downstream, going into chemicals in very big ways, as they are doing, of putting refineries all over the world and having a refining capacity of 10 million barrels a day. That's going to cost them a lot of money. That's why they're borrowing this 10 million. I don't think they've borrowed any money to buy SABIC at this point. So if they take over SABIC, well, the first thing they'll have to do is break SABIC apart and privatize some of the companies within SABIC. In my estimate, that will bring them $10 billion. We're still short of 60. So I'm not sure where they're going to get the 60 billion. They could issue shares, but we talked about that before. So I think the IPO, you have different people want to do different things. I think the Ministry of Energy would like very much the IPO to happen because they want Saudi Aramco to be transparent so that the royal family has no say on how to manage it. Somebody else told me just last week, no, this is totally wrong. The Ministry of Energy doesn't want to do the IPO. It's PIF who wants to do the IPO. So, I'm not sure where we stand. But basically, the company is structuring itself today. They're continuing full speed to structure themselves to do the IPO. And I think the IPO will happen because the transparency issue is very important for the kingdom.
Rachel, did you have something you want to add there?
I was just going to sort of jump in on that point of different reasons for doing sort of the IPO and, in a sense, contradictory reasons. And I think that's part of why, obviously the delay, but also that this is very much a 2021 or something at best. Could happen, but there's a lot of there's a lot of work still to be, still to be done. I think Jean-François summarized all of it, all of it well, but that sort of tension over the tension over why they're sort of doing this and what the money is going to go towards, because not only is $70 billion in debt sizable for one company, it's a sizable amount even on the Saudi Arabian sort of balance sheet, the space of the sort of sovereign balance sheet, and the speed of increase would be concerning, particularly if that was depending on how that money was used. To what extent is this a financial transaction of moving assets around? What is being spent sort of locally? I think there is a real, sort of a real question mark. There was a period of time that parts of the Saudi balance sheet were quite easy for analysts like myself to view in comparison to other comparable GCC countries. That's not so much the case. That's not so much the case today.
Right. Do you have any points, or should I go to the?
I mean, just very briefly, I think what Jean-François, the professor, mentioned, and is very important, is that the valuation, the big question that everybody has in the valuation, this is something that we talk about when we look at Saudi Aramco. You can't look at it as a national oil company. You have to look at it as a vertically and horizontally integrated global hydrocarbon company. You have to look at it as like a Total and like a Shell and like a BP. And in that regard, that dovetails with what they're doing. It dovetails with the acquisition of SABIC, and it dovetails with the valuation of 1.8, 2.1 trillion. And we have a beautiful table in the book outlining that that valuation.
That's worth it.
Yeah, absolutely, absolutely. But I think, as Rachel pointed out, it's very important, is that there's just a lot of contradictions, and you have to work through the contradictions. You want the IPO because you want transparency. You want transparency because you want reform, but you can't get the IPO because the people who don't want the transparency. There's all these things going on, and that's what you have to work through. But the analytical that you see the press hanging on, like, oh, this IPO is never going to happen, miss the broader point. Right? There's a lot of other things going on here, and it's a part of the IPO is a part of a broader push, and that's how you have to view it.
Yes.
Thank you. If I can, sort of two.
I think we just have a microphone headed your way.
Secure this.
Thank you. If I can, perhaps 2 or 2.5 questions, but they're short. Does Sharia compliance cap out the development of the market financially? And related to that, is there something culturally about the Gulf which could inhibit financial intermediation? It's culturally, the difference between the United States and Germany is very, very different, and we have very different financial markets. And a second, totally different question is the fixed exchange rate hasn't been mentioned. That also could be something that arrests financial development. Investors generally don't like it since 1998.
Well, I'll start. I'll start on that. I'm sure everybody has a lot of points here, but in terms of the financial intermediation, no, I frankly don't think there is any difference. Basically, I mean, the financial intermediation has existed in the Gulf forever. I mean, it has existed ever since the pilgrimage started in Mecca, even before. Yeah. So I think people are quite happy to take money, to borrow money. There's been all this lot of literature about what is interest, what is not interest, and ultimately, to make a very long story short, there is no difference. So, and it's a very long story, which I'm making very short. But, they use, like the sukuk is a perfect example of how you can make a long-term bond without calling it interest. And in fact, a lot of scholars of Islamic banking are saying, oh, but a sukuk is not a true instrument, we cannot have it. And then they get shut up by the rest of the countries because they want the money from the sukuk. So so I would say that has not been a major hangover or a delay for the markets over there. The fixed exchange rate is interesting, what you mentioned there, because in fact, we see that often when the price of oil goes down, you see in the press, well, maybe the Saudis and the UAE and so on should devalue their currencies. And the fact is, most of their income is in dollars, but most of their expenses are in dollars. So, in fact, it would make almost no difference, really, in my view. And so again, the short answer, but that's my what I was thinking. Right, Rachel, maybe you.
So let me take the fixed exchange rate piece, because I know I mentioned it in passing to differentiate between the dollar and the non-dollar, the local currency debt. So I think my take on fixed and dirty, sort of fixed, floating and dirty floating currencies is that investors really don't like fixed exchange rates if you don't have the assets to back them up. And so for a period of time, like if I draw a distinction between the Gulf and some of their oil exporting peers that had very little foreign currency reserves, foreign currency assets, I'm thinking about Nigeria, I'm thinking about Kazakhstan, elsewhere, even Russia. Those were countries that either, they didn't stick to a peg, they tended to every so often move it, but they also tended to not have sufficient reserves to back up that peg, as opposed to, and this is very much a non-oil producing country, Hong Kong, which has more than enough foreign assets to maintain that. So I think one of the things to look at when you're thinking about what's the level that might put the pegs in jeopardy, it's looking at what's the amount of foreign currency liquidity and what do the portfolios look like. Now, looking theoretically and in a debate that I think no policymaker in the Gulf is willing to engage in right now, it almost would be better if there were going to be a change made. You want to do it before you rack up an awful lot of liabilities in U.S. dollars before you make a change. Now that's where I think this currency composition of assets and liabilities is so important, and I'm thinking on the savings level. So not just the trade flows that Jean-François highlighted, and I agree with his point, but what's the composition in that way. So the last thing you sort of want to do is suddenly have 100% of GDP in foreign currency borrowing and suddenly have to sort of devalue, and then the what you owe is effectively 200% of GDP. I'm just assuming I'm just making an assumption there. So the point being, I think there's several reasons to watch a quick run up in debt, whether it's in local currency or in hard currency. I think there are some market sizing issues that come up for smaller GCC countries issuing in local currency. Maybe a little less so for Saudi entities issuing in Saudi Riyal or and the like. So, but that would be. But I'd think of the exchange rate decision as being tied to the overall economic, fiscal, external balance questions rather than in that context. Some of these countries that are effectively sizable offshore banking and global banking centers, I think, really see that predictability of exchange rate is a key part of that goal, and so I think there's likely that they'll build up those reserves. On the Islamic finance side, I guess one anecdote I would say is that in this period of time over the last several years, when there was an urgency to issue debt, we actually saw Sukuk being a slightly smaller share of the issuance. I'm thinking about in 2015 and 2016. Over the course of the last 2 years, that volume has started to shift. And I think, as I think we all keep saying, Saudi Arabia is a game changer in this regard. And in volume, I think we're far from tapping out on the global demand for Sharia-compliant assets. That could come at some point, but I think we're far from, we're far from that. One question mark depends a lot on which instruments one's talking about and how much there is a reliance on underlying, particularly real estate and commodity assets. And so that would be something I would watch there, but I think that's more of a long-term story than a short-term one.
Sam.
Yeah, sure. Very quickly on the foreign exchange, and I agree with the Sharia law, the Sharia financial instrument discussion. And I think that one thing to add to that is just we've seen the depth of these markets and the spaces that they're going into just consistently expand. I mean, you can get a Sharia credit card, you can get a Sharia debit card, right? These things shouldn't exist, but they do. So these markets are only going to grow. I don't see it tapping out. But again, this is something that you're expert in, and I appreciate your comments. With respect to the foreign exchange, I don't diverge from any of the comments here made. I think just one of the things I like to remember when I'm assessing the probability or the potential for any kind of major policy changes in the Gulf is that the primary goal is not financial growth and depth. The primary goal is ensuring economic stability and quality of life for their population. And that's the way these governments think, and it's a trade-off for them, right? And when you start thinking about looking at and in that regard, building strong, massive financial markets is a secondary objective against this primary one that keeps them keeps the government structure the way it is. And when you start looking at a devaluation or a change in the foreign exchange regime, I don't have to, they're very painful. And if you look at Egypt as an example over the last 3-4 years, that's not something that I imagine any of these Gulf states saying, hey, yeah, let's do that. So I don't see that. I just don't see it from a policy perspective.
I think there is just as I mentioned earlier, with the trade being all in dollar, and selling in dollars and buying in dollars, but there's something you have to keep an eye for, and I think we talk about it in the book to a certain extent, is the possible development of instruments in the Shanghai market for buying oil in renminbis. And if that became very successful, and it seems to be growing, that's very interesting, because it would mean that Saudi Arabia and the Gulf in general would start having very large balances in renminbi and would be less dependent on having the dollar to sell and to buy. So that may change the equation. Rachel, what do you think?
I completely agree. I was going to mention that, but also highlight we're now in an environment, it's more political than actual action, but we are now in an environment that because of sanctions, because of a variety of things, we have certain European officials questioning again. The Europeans go through cycles of questioning the dominance of the dollar, but not creating enough euro-denominated assets to really challenge it. But we have an alignment of some European officials and some Russian officials and concerned about dollar transactions. Well, I'm not saying this changes quickly. We've seen with their scaling back of some other sanctions, diverting measures, that things can't happen. The weight of the U.S. And the U.S. dollar-denominated financial system is quite extensive. But I would watch for instruments like what Jean-François mentioned in China, some in Europe, and around, and probably would happen first where Russia was concerned, but things like LNG contracts, whether we start to see more sort of payment terms being in euros or other currencies. Those are the catalysts I would watch for. And then, but at this point, even though most of the Gulf's imports more of the Gulf's imports are coming from Asia, and to an extent Europe, they are in U.S. dollars. But those are some of the things I would watch for, and over this, what we were talking about, what happens in the next 40 years, these could be quite salient in even half that period.
Great. Make sure that we get to as many questions as we can. Yeah, right here.
I'm Mona Shazli from Columbia College. On the topic of exchange rates, one idea that has been floating is, rather than linking to the dollar, a commodity and a currency mix. And that way you get a little bit of insulation against close ties with the dollar or oil. And then connecting this with the idea of ensuring economic stability and revenues denominated in dollars, I would say maybe the expenditure and social contracts that the government has to comply to because of the regional instability. They cannot all of a sudden cut back their spending and do away with the subsidies, so they are committed to a large extent to satisfying the contracts. So these would be denominated in local currency. And so if you are able to devalue your currency some and not do quite like Egypt by totally floating, but it gives you somewhat of a buffer. And
if I could just ask you to just finish up with a question, that would be great.
What thoughts do you have about a commodity currency basket and the social obligations?
Kuwait, officially Kuwait is on the basket already, but 80% of the basket is the U.S. dollar. So I think it. But I don't know exactly what to answer to that. Actually, I really don't know.
I mean, I'm lucky enough to look at commodity markets all day and get paid to do it. And commodity markets are volatile, like just unreal. And I just. Yeah, I mean, I think diversification is a great idea. I think it's a great point. The USD has a strong tie to, well, it's the oil price that has a strong tie to the USD. But I think it's an interesting point that could, be a gradual step. As you said, any step taken would have to be very gradual because of the need to maintain just status quo in a region where, the balance is just so important.
Gradually, or else a long time from now and very quickly, right?
Well, one of the two.
Which is, I mean, I think the challenge, and that's where focusing on this question mark of what's the financing structure look like and what do the imbalances look like. So on your question, so I've done some work on including commodity basket and worked with a colleague of mine on a piece that was published back in 2007 arguing for, that in a theoretical level, including oil as part of a basket could make sense. I think technically there are some challenges in doing that, and there is some compelling research on it. The question mark is, what's the basket, what's the weights, and I think one of the concerns, I go back to something that I'm not sure, I think it might have been Jean-François said at the beginning, which is this concern about sort of speculation and trying to avoid speculation uncertainty. I think you raise, so that I think is one of the complications. On this issue of social contract and how much policy space do you get on having a flexible exchange rate, that I think brings us back to imports. To what extent is is consumption being fueled by imports, and where are those imports coming from? So a country like many of these that is still quite reliant on imports, then you can end up with a lot of imported inflation. And so that's where, again, I think that composition becomes an important story. We've seen moving to more flexible exchange rates as an important buffer for some other oil-producing countries, places like Russia, places like Kazakhstan, and other countries, not only Egypt, but also places like Nigeria. Egypt, of course, only now becoming a net energy exporter.
Brand new.
Brand new. But so to places like Egypt and Nigeria, that the unwillingness to let the currencies adjust led to real problems for the private sector. They couldn't access foreign currency. So I think there's a number of cases there, and a lot of it depends on do the entities within the country have access to the currency, sort of the financial flows that they need, and what's the resilience, built in there.
I think that, if I may, there's a technicality which is very telltale, it seems to me, that the GCC countries have been unable to start their own currency. They're all pegged to the dollar. De facto, the money of the region is the dollar. But if they could have one unified currency, that would really help make much more powerful decisions on whether they should change the rate a little bit or not, but they cannot agree on where the central bank is going to be located. And that's a rather small detail, it seems to me, but that's the key problem. So we have a Gulf Cooperation Council which does not cooperate very much. So we have an issue there, and I think it's an indication more than anything else.
Exactly. I mean, I think the haggling over where the central bank or the entity is housed is probably smokescreen for things that we've seen in other monetary unions that lack fiscal unions, Europe, about what happens if you don't have those flows. Now, there's other reasons that have led to lack of cooperation in the GCC, but I think that question mark, we see what happens when you don't have when you actually would need or arguably should have a different strength of currency and different fiscal policy and different monetary policy across regions. And I think that I find it hard to see the GCC. If they can't cooperate on some of these financial markets we were previously talking about, I think it's harder to do on the monetary side. But maybe it's a chicken and egg problem.
That's true.
Other questions? Let's see here. Yes, in the back.
Thank you. My information is that the Gulf is a major destination of stolen Russian billions for money laundering. So how do you reconcile that with the rule of law and money market regulations?
We actually spent a little bit of time talking about Dubai in the book, and we don't go as far as saying that it's the stolen Russian billions. We talk more about the stolen Iranian billions,
Yes.
which are probably much bigger than the Russian ones. And it's very this what you're talking about here really applies to Dubai and no one else. And Dubai for the last century has always managed to survive on the crisis in other places. And they have set up their own system. It works very well. They're very good at it. But they do receive money from Afghanistan. They receive a great deal of money from Pakistan. They receive a great deal of money from Iran, the largest by far, and to a certain extent, the ex-countries of the ex-Soviet Union. That has been really the source of success for Dubai, and in many ways that's also a problem for them because of the regulations now worldwide, where you have they cannot transfer the dollars they get from all these crisis countries in Dubai. They cannot really put them in New York or in London because you have the know your customer rules. So they keep the money in Dubai. And what do they do with it? Well, they fund this huge real estate growth that's taking place. They fund Dubai Inc. So that's been the saving grace of Dubai, and they provide a service to the rest of the world because a lot of people want to have a place to put their money, and in case of crisis, bring their families. So they buy villas, they buy apartments, and so on. So that's not going to change in a way because there will always be a crisis somewhere. You know, so I don't. I think the many billions from Russia. I think we don't know. You know, maybe it's up and down and so on. It's probably not as big as we'd like to think because it's very romantic just to think about all that. But the fact is that it does happen for sure, and Dubai does it perfectly, you know, legitimately on their own, and they do it very well.
We actually show in the book some of our analysis around. Around money that flows. Well, sorry, let me rephrase that. We do some analysis around re-exports out of Dubai, and we have some schematics. It's really a great book. Some schematics and some tables showing. And showing.
We'd be concerned if you guys didn't. Sorry.
A little bit of bias. So about showing the re-export trade out of Dubai and how that functions as a mechanism to bring money into Dubai, and that money is oftentimes not necessarily from the most, you know, mom and pop places, right? For lack of better terms. But what we've seen is the trends as sanctions ramped up on Iran, we've seen a very dramatic increase in re-export trade out of Dubai. And as sanctions were rolled back after 2014, 15, 16, in that period, we saw re-export trade decline. And I think just to keep it on your question about how does that relate to rule of law, in reality, over the last year, and as this was going to press, and we wrote about it as it was happening, there was some new laws in Dubai that were, interestingly, harking back to what we said earlier, Dubai was pushed to apply them by Abu Dhabi around money laundering and kind of like know your customer laws and all that. And what we saw in that period was that a series of agreements between Oman and Iran around re-exports, around financial trade, and that is all to say, I'm not trying to point fingers at any country, but it's going to happen. It's a part of the economy, and frankly, you have the same thing going on here. I mean, HSBC is what kind of bank is HSBC, right? And with all the it's a great bank, nothing against it. But you have all these, you do have accusations and you do have illicit trade, and you do have lawsuits, and it's nothing unique to the Gulf, and it's nothing unique to finance, and it's probably going to continue happening.
I want to hear what Rachel has to say. I would just like to throw out there, though, I wonder, and this could be something for the panelists to discuss after, to what degree the EU's money laundering blacklists, we saw that about a year ago apply to the UAE, and then recently with Saudi Arabia. To what degree that has been playing a role in some of these topics that the gentleman just talked about, and with illicit capital flows. Rachel, sorry to go ahead.
So completely agree with what Samer was just saying around the sort of dynamic between Abu Dhabi and Dubai on know your customer and the FATCA regulation. Some of this is an environment of tighter compliance that we see globally throughout financial markets, of which, of course, U.S. money laundering and AML measures, European measures are part of that. Now, when you asked your question about the Russian millions, I originally kind of also went back to this dynamic of you had a period of time where a lot of those were, some of them might have been in Dubai, some of them were in Cyprus and other places, as Cyprus no longer was a place where that was part of doing business and propping up the banking system. Where else did they go? So that kind of question, I think. They're politically between Dubai and Abu Dhabi, the tightening of measures and greater know your customer, particularly as focused on the illicit flows and particularly relating to Iran, was a little politically more palatable to deal with. I think the involvement on the European lists has been a little bit, it's a little harder to sort of grapple with because I think it kind of goes beyond that traditional Iran flow. But I think it's a developing story, and it's going to be something where there's greater focus and scrutiny, and with greater focus on counter-terror financing, AML measures, and the like, particularly out of the U.S., I think we're going to also see greater kind of compliance costs and compliance measures, and it's hard to stamp these things out.
I think we have time for about one more. Maybe we can fit in two if they're brief. Are there any more questions out there?
And if we agree to be brief in our answers.
That's true. That would probably be the more important part.
Yeah, we're
any last questions? We are getting. Any of the panelists? Any final thoughts? Topics you wanted to cover?
No.
No? Okay. Well, I think that just about does it. I'd like to thank everyone that attended today, those that are watching online. If you do have any questions, feel free to come over to the panelists as soon as we wrap up the event, have a little bit more of an informal chat. And thank you for coming. We hope to see you at future events.
Thank you.
Thank you very much.
Yeah. Thank you. That was great.